Well, welcome back, ladies and gentlemen. Today we are going to be talking everything crypto. We are going to be talking about the stock markets, the bearish news that's coming out here, guys, and we're also going to be diving down into liquid meta, the infrastructure that is powering decentralized finance. Joining us today is John, the Chief Executive Officer, to offer some pretty incredible insight and some incredible experience along the way here. Thanks so much for joining us today.
Yeah, it's my pleasure, Kyle. Pleasure to be with you again.
Now, you're a very knowledgeable dude, and I'm really looking forward to broadening this conversation in these very volatile markets. And I guess, first and foremost, being kind of more of an expert in the crypto field here, what are your thoughts on kind of this macro environment? Because it really seems like Bitcoin, a lot of these crypto markets are trading off what's pretty much going on within the NASDAQ, because I guess there's a lot of institutional ownership, and we're starting to see some big funds that rolled in, and it seems to be trading the same way. But how do you feel about the general markets there?
Right, so let's break it down a little bit. The crypto markets are in and around $2 trillion of value. The vast majority of that value resides in two asset classes, BTC and ETH. Those two assets are really the drivers of the way the bulk of the market works. They're the vast majority of market share or market cap of overall crypto. And what we're seeing now is very tight correlation between those two tokens, those two asset classes, and macro environments. So specifically, risk assets like the NASDAQ or the equity markets at large. And equity markets are almost the tail wagging the dog here. And what's happening with those assets are really derivatives of some global macro uncertainty. There's a couple of things driving global macro uncertainty. One is geopolitical instability we're seeing in Russia and Ukraine right now, which is really causing some concern for investors. So we're seeing a lot of risk off as a result of that. The second thing we're seeing is a little more fundamental. We're seeing rising interest rate expectations given a surge in inflation over the past few years. So those two factors are really creating this risk off environment. And like I said, because Bitcoin and Ethereum are so tightly correlated with other risk-off assets, we're seeing that trickle-down effect across all of crypto. So it's been a very, very bearish sentiment throughout the entire sector, working on now the last 4 weeks.
Yeah, and kind of expanding past that too. I mean, before we kind of went live here, we were talking about the stock market, and I've kind of got a bearish sentiment because as these other companies have been falling off like a domino effect, I mean, we saw Shopify, Facebook, it's like one after another here. And when you look at like the S&P 500 indexes like Vanguard's VOO, I think people are under realizing that they're basically, the way they kind of add those funds is based off market cap, right? And because Apple and Microsoft and Google have primarily been holding up somewhat okay against these other stocks, it's forced this overweighting in them. And now I think Apple's over 7%, Microsoft's at like 5 or 6%. And I feel like if we get that last little domino effect, because those companies didn't offer any guidance, that like we could easily within just a few stocks dropping 20% would immediately put the entire S&P in a bear market. And I'm very intrigued to see how this is going to roll out because these next few quarters are going to be a bit rocky. But do you got any anecdotes or what's your thoughts on that?
Yeah, so there's a couple of things that have really paved the way for this imbalance between the top decile or even the top 5 or 6 companies by their market caps and the overall the balance of S&P 500. So in an environment over the last 10 to 15 years where we've seen declining interest rates, markets have looked for yield and has looked for growth. And that's why we've seen companies like Microsoft, like Amazon, like Google, the FANG stocks, they've performed so well because they're phenomenal businesses with phenomenal business models, and they've been able to grow their earnings over that period of time. So the markets have really chased those organizations. Plus, they're mega caps and they're very liquid. So what we've seen is as a result of declining interest rates and a market start for growth, those companies became quite favorable. The other thing that we saw is the rise of the passive investor, okay? The passive ETFs that have really dominated markets and market headlines for at least the past decade. And you can see, and I've written about this many, many times in my prior career, about this imbalance between the passive investor and the active investor. A lot of the capital over the last decade has moved from active to passive. So the pendulum had really swung in one direction. And what that means is if you were an ETF or you were some type of passive investment vehicle, you were forced to own the largest parts of the market. So you really saw, a bunch of that capital working its way into the FANG stock, so to speak, which really created this imbalance between reality and perception. The reality is that the markets have been overall unhealthy. The underbelly of the S&P 500 for the most part has not performed as well as it would seem on the surface. The reason for that is because all of that passive capital that went into ETFs that purchased the FANG stocks, Microsoft, Google, Facebook, Amazon, etc., that really propped up the overall markets. If you were to remove those from the overall S&P 500 or Nasdaq, you would see the performance in those indexes, those indices, would have been significantly lower than they were. So you're not getting the full picture if you're just looking at the broad market. You really have to dissect it. As we work towards rising inflation, as we work towards rising interest rates to combat, I believe you're going to start to see some of that passive capital come out back into active portfolio management. If that's the case, then we could be at risk of a decline in the higher decile of the market. So Amazon, Facebook, the FANG stocks again. And if you see those stocks starting to get sold, you could see some overall market pressure, certainly over the next few quarters / few years.
Yeah, it's pretty intriguing insights, man. And I want to kind of bleed down a little bit here because I'm really intrigued to see what's going to happen within the crypto market. Because if all of these kind of geopolitical tensions and a lot of this stuff starts uprising, that money's going to be looking for places to go, right? And I feel like right now, crypto correlates to some of these top, like these NASDAQs and a lot of these tradings. But I feel like when the market shifts and they start realizing what the crypto markets are and the decentralized asset of it, it's just going to be neat to see how that plays out. But the intriguing thing is Liquid Meta is removing the volatility to kind of generate revenue. And I wouldn't mind you breaking down that business model, because how you guys are operating within these markets is very intriguing, to say the least.
Right. So Liquid Meta is a very interesting case study. So what we are doing in our business is we're building a platform. We're building technology that ultimately is going to provide a bridge between traditional finance and traditional capital markets and decentralized ones. And we're providing that bridge in order for institutions to access, automate, and scale within DeFi in a low volatile manner. So where we are providing capital to asset classes, layer one tokens, crypto assets in general that swing around, that move, that have great volatility, we are trying to reduce that exposure through pretty much an active hedging program inside our business model. So it's providing that access to a very volatile industry in a very low volatile manner. So really capturing the yields and the token rewards and the economics of decentralized exchanges without providing investors that exposure to that high and extreme volatility. It's a very thoughtful way for us to bring institutional investors, enterprises into this world without exposing them to real balance sheet erosion.
Yeah, and I want to talk a little bit about that institutional side, because it's something Kevin O'Leary's talked about a lot. It's really hard for institutions to kind of drive into the crypto market, and I find that through these kind of third-party accesses like yourself, they're able to do that. Can you just talk a little bit about that? I know you had a recent partnership that came into play there with Civic Technologies, and you guys are kind of really working on building that pathway for them. Can you talk briefly about that?
Yeah, so let's just put Civic, the partnership, aside for just 1 second, and let's talk about some of the hurdles for why institutional investors, they cannot access or don't feel comfortable accessing crypto and DeFi. For starters, decentralized finance, DeFi, the fastest growing segment or category of the crypto markets, is just 4 years old. So it's brand new, it's nascent. And anytime you have an emerging industry, large and very robust organizations, institutions, they're quite fearful. They want to see a longer period of time. They want to see more history before they jump in feet first. So they're apprehensive. Clearly, they're very curious because of the disproportionately higher yields that can be ascertained inside crypto and decentralized finance specifically. But they're very hesitant to just go in in a big way. So it's going to be a very slow and methodic approach to that. Now, the other the other hurdles for institutional investors accessing crypto is regulations. Because the industry is so new, the regulatory framework has yet to really be built or established. And until that happens, which could take many, many years, it will happen, but until it does, it'll take time. And until institutions and enterprises really feel comfortable that it is a regulated environment, I don't think that you're going to have massive adoption. You will have adoption, but not massive adoption for several years. Bitcoin has been around since 2009, 2010. We've been around for a dozen years, and it's just slowly starting to become commonly available inside larger institutions. We just saw the first ETFs that could hold the Bitcoin inside the US in 2021. So it's been a very slow adoption curve. It's happening and will continue to do so, but I think it'll be a slow and methodic process. This is where Liquid Meta comes in. It's going to be our role, our job as a business, to show institutional investors that you can do this in a very, low volatile and thoughtful manner. And it's almost like we're going to be able to hold the hands of these large organizations as they start to dip their toes in the water. One of the ways or tools that we can do that is with a company like Civic, a recent partnership that we announced just a few short weeks ago. Civic is really trying to provide the ability for institutional investors to know who their counterparty risk is when they're trading inside decentralized finance. One of the biggest pushbacks that we receive in DeFi in general is you don't know who the other side of the trade is, so to speak. And until that gets resolved for institutional investors, it's going to be very difficult for them to want to deploy a significant amount of their capital into that industry. What Civic is doing is they're providing a pass or a piece of technology, a token, that will identify you as a KYC or KYB participant inside a decentralized exchange or a platform. And so it's going to be our business at Liquid Meta to help onboard institutions using Civic and building greater transparency and greater visibility inside decentralized finance at large. So that's really the core of the relationship and the partnership. We see this as really a long-term business partnership, and it should be beneficial to both of our companies for many, many years.
Yeah, that's pretty intriguing to hear about. I got to ask you, man, I mean, you've had over 20 years in the capital markets. What was this aha moment with crypto? Just talk a little bit about your experience there, because this is a pretty in-depth conversation to how you guys are operating in this field.
Yeah, so when the other co-founders of Liquid Meta, who have spent many more years inside crypto as entrepreneurs, as technologists, as business builders, when they approached me and started to really educate me on decentralized finance, the aha moment was you could generate these disproportionately higher rates of return using capital at very low costs of equity or cost of debt. And you could generate a very, very significant yield without a trading desk or a brokerage account or any type of third-party intermediary. So they showed me that it would be faster, it'd be cheaper, and it would be more efficient to generate significantly better returns in DeFi than it was in TradFi. Now, coming from the world of TradFi, traditional finance, when you could create that type of environment for somebody such as myself, it was really a no-brainer, and it was game on for me. That was the aha moment.
That's great to hear, man. Yeah, this is going to be a wild ride. Anything else you want to follow up with here before we finish up?
No, what I will say is that I want to just go back to the correlation between the crypto markets and traditional markets, such as equities. If you go back to January, February, March of 2020, when the markets were breaking down because of the pandemic, so that was, one of those black swan events that the market wasn't anticipating, right? There's always going to be those types of catalysts, either to the upside or to the downside in all types of financial assets and markets. We should always anticipate that those exist. This one happens to be a geopolitical tension today between Russia and Ukraine. So the market is very, very nervous, and there's a great deal of uncertainty that exists. My point is that there will always be these periods of market swan catalysts in the marketplace. Let's go back to the last one in March of 2020 in the pandemic. Crypto markets actually performed, the correlation was inverted. So crypto markets performed quite well, while equity markets performed quite poorly. And since then, those markets have really tightened. Correlation has been extremely, extremely tight. I think that we are at the cusp of, and I don't know when specifically, but I think that correlation again will start to deviate. Crypto markets will start to outperform traditional markets. And it's a matter of time, but I'm very bullish on the sector. We were at one point at $2 trillion of market value. We've lost $1 trillion of market value, if you can believe it or not. And I think that that will start to be recaptured over the next months and years. So I'm quite bullish, quite favorable. And again, I'm biased, but I think Liquid Meta is an extraordinary opportunity for investors to really participate and capture in that upside.
On that note, John, I appreciate your time, and I pass the question off to you guys. I want to know what you think in the comment section below. I've been working with John. You can head on over to his YouTube channel where we offer market updates and talk more about their business as well. I'll leave all the links in the description below. But on this note, really appreciate your time, John. Thanks so much for coming out.
My pleasure. Always a good time.
On that note, folks, stay cool, stay awesome, and as always, I look forward to catching you in the next one.